His parents bought their house in 1987 for $94,000. They sold it in 2019 for $412,000. They talked about it for years afterward like it was the smartest financial decision two people had ever made. And by the numbers, it looked like they were right. What they never calculated, because nobody does, was everything else. 32 years of property taxes, 32 years of maintenance, repairs, and replacements. The roof that needed replacing twice, the HVAC system, the kitchen remodel they did in 2004 because the original one was no longer acceptable, the second mortgage they took out in 2009 when things got tight, the insurance premiums that climbed every single year. When you add it all up, really add it all up, their actual return on that house was closer to what a low-cost index fund would have produced over the same period, without the broken water heaters, without the property tax bills, without being unable to take a job in another city in 2011 because the house hadn't recovered its value yet and they couldn't afford to sell. They didn't make a bad decision, but the story they told about it, the story most Americans tell about home ownership, was missing most of the numbers. And in 2026, with mortgage rates, home prices, and the cost of ownership at historic intersections of difficulty, that incomplete story is leading millions of people into the most expensive mistake of their financial lives. Start with a number that reframes everything. The median home price in the United States in 2026 sits above $420,000. The average 30-year fixed mortgage rate is hovering between 6 and 7%. Run that math. On a $400,000 home with a 20% down payment, $80,000 that you had to save, which is itself a multi-year project, your monthly mortgage payment is approximately $2,100. But that is not your monthly housing cost. Add property taxes. In most states, that is another $400 to $800 per month depending on location. Add homeowners insurance, another $150 to $250. Add PMI if your down payment was less than 20%. Add the maintenance reserve that every honest financial planner will tell you should be 1 to 2% of the home's value annually, which on a $400,000 home is another $300 to $600 per month set aside for the inevitable costs of owning a physical structure that ages, breaks, and deteriorates. Your actual monthly cost of home ownership in 2026 on a median-priced home is somewhere between $3,000 and $3,500 for a house, not a luxury property, a median house. Now here is where the conventional wisdom starts to crack. The argument for buying has always rested on two pillars. First, that you are building equity, paying yourself instead of a landlord. Second, that real estate appreciates, and you will eventually profit from the investment. Both of those things can be true and still not justify buying in 2026. Here is why. In the early years of a 30-year mortgage, the first 7 to 10 years, the overwhelming majority of your monthly payment goes to interest, not principal. On that $400,000 loan in year one, roughly 80% of each payment is interest. You are, for almost a decade, largely paying the bank. The equity builds slowly. The interest leaves permanently. Meanwhile, the renter who chose not to buy took that $80,000 down payment and invested it in a diversified index fund, returning a historical average of 7 to 10% annually. After 10 years, that investment has grown to somewhere between $150,000 and $200,000 without a single repair bill, without property tax exposure, without being geographically anchored to one address. The homeowner, after 10 years of payments, has built meaningful equity, but has also paid the bank hundreds of thousands of dollars in interest and spent tens of thousands more on maintenance and taxes. The math is closer than the culture suggests. In many scenarios, in many markets, in 2026 specifically, it doesn't favor buying. There is a hidden cost of home ownership that almost nobody accounts for, and it might be the most consequential one. Illiquidity. A home is not a savings account. It is not a stock. You cannot access its value quickly, cheaply, or without enormous friction. Selling a home costs 5 to 6% of the sale price in agent commissions alone. On a $400,000 home, that is $20,000 to $24,000 gone before you see a dollar of proceeds. Beyond the transaction costs, owning a home anchors you geographically in an economy that increasingly rewards mobility. The best job opportunities in 2026 are not evenly distributed across the map. They are concentrated, they shift, and they require the ability to move. The renter can respond to opportunity. The homeowner calculates whether their equity position allows them to sell, whether the market timing is right, whether the next city's prices make the move financially viable. Home ownership trades flexibility for stability. That trade made sense in a stable, single-employer, long-tenure economy. That economy largely no longer exists. Here is the thing nobody in the real estate estate industry will say out loud. The cultural pressure to buy a home is not neutral. It is generated, maintained, and amplified by an enormous ecosystem of people who profit from the transaction. Agents, lenders, title companies, insurance providers, home improvement retailers. The 30-year mortgage is one of the most profitable financial products ever designed. The bank collects more in interest over the life of a standard loan than the original price of the home. That is not a side effect of the system. That is the system. Home ownership is not inherently bad. For the right person, in the right market, with the right financial position, it remains a sound long-term decision. But the blanket cultural conviction that renting is throwing money away, that buying is always smarter, always building something, always the responsible adult choice, that conviction was built and is sustained by people who make money when you sign the mortgage. If renting were genuinely, measurably, obviously inferior to buying in every scenario, they wouldn't need to spend billions of dollars a year convincing you that it is. The fact that the argument requires that much marketing might be the most revealing data point of all. If this made you look at your own housing decision differently, share it with someone standing at that crossroads right now. And if you want to understand the other financial narratives being sold to you as common sense, the next video is already waiting.